what I want to talk about this morning is to take some of the questions that have been sent to us in advance. We have a series of questions about the program itself, so we're going to answer those first. And then we also have received over time many interesting content questions about financial stability in the world today. So we have one of those already in advance for Professor English, and then I'm going to take one. If you have any questions about the systemic risk program or about financial stability in general, questions about financial stability, systemic risk in the world today, please post them in the Q&A. And we will, so we have both a chat and a Q&A here, but you can just post the questions in the Q&A, because then I will know that we should get to them. They won't get them, they won't scroll past them. And we'll come back and just continue that conversation after we've answered these starting questions. So first, just a little introduction to our program. And I know that people have likely seen the basic details on our website, but I want to talk about why do we have it? What's the point of it? And that will also help frame some of the answers to some of the questions that you have. So I would say Bill and June and I were all working on topics that are pretty closely related to course materials that are now in the systemic risk program, working on financial stability topics for quite some time. And part of what we were doing was having conferences, annual conferences, where we'd bring in mid-level and senior central bankers and other regulators from around the world to talk about financial stability topics. And what we were seeing when these people came through is just how they were building up very large and important divisions within their institutions, but they really didn't have anybody who was educated about financial stability. There were a lot of smart people who had a general education in central banking or economics and finance who moved over to specialize in it, but it was really a completely new field, just as there were no doctors who had learned about COVID-19 in school. Since COVID-19 didn't exist, we didn't really, with a few exceptions, mostly from Asian central banks, because they had gotten with the program a bit earlier than anyone else. There was not a depth of knowledge or even a place where people had pulled together what was known and tried to review it about how to prevent and fight financial crises. So since we were starting to do this all over the world, we thought it might be a useful thing if there was an educational program somewhere that did it. And we pulled this together at Yale, and we've been very, very happy with the quality of the students and what they have done with their careers when they have left. So the first question actually I wanted to address was somebody wrote to us and asked, which are the most important aspects the committee looks for in the application form? And I think really what we're looking for is somebody who wants to make a career in the world of systemic risk regulation, financial stability regulation, macro-prudential policy. What we're looking for is somebody who, that's what their passion is. And most of the time, they will find jobs they will already have jobs, and they will want to continue in those jobs at central banks or other major regulatory agencies in their country or international organizations. That's the typical profile of somebody who wants to have a career in that area. And they've often been told by folks inside their institution, hey, this is a good program, we've heard about it, or they've discovered it on their own and convinced the people inside their organization that this is a useful program for helping them to kind of embark upon a career in the area. So the main thing we're looking at is not, what are your GRE scores or GMAT scores and what were your grades in college. We want to make sure that you can handle the work of the program. And most of the folks who have made it through the competitive process to get jobs in their central banks and have been working successfully in their central banks or in other agencies for several years have those skills, and they're fairly easy for us to verify that they have those skills, that they're going to be able to get through the work and do the work. But we're really looking for a passion for this particular area. Nothing makes us happier than when our students graduate and then we get an email shortly thereafter about their promotion or about their movement from one part of their institution into the part of their institution that focuses on systemic risk, financial stability. And we know that the best chance of having those types of successful students are people who have a passion for this area and see how important it is for the world. So that's the most important thing. There's no one individual thing. We don't have a specific GMAT cutoff or grade cutoff, or you had to go to this kind of school or major in this subject. Certainly, no. If you have no background in economics at all, in central banking, in regulation, any of those things at all, you're just coming from outside that world, then it's likely it's just you wouldn't really know that you were interested in our program because it's really quite specialized. So we are not looking for any one thing in specific other than that passion. Hey, the second question on my plate is, should I expect COVID-19 to affect the way the masters would develop during next year? So there's really two ways to answer this question. One is the operational way. How do we run our program? And how will it work for you coming to our program? And second, how does it affect the content of what we do? So forget about the operation side, but the content side. So on the operation side, this year already, things look pretty normal. The only sense in which they're not normal is that folks are wearing masks in the classroom and when they are indoors in our building. But all of our classes are in person. We're not doing anything remotely. And we spend an awful lot of time with each other unmasked because Bill English has discovered wonderful places in our courtyard for us to do some of our coursework outside and our colloquium outside. So we actually, I would say it feels pretty normal, and we know what everybody's faces look like. And we're getting a lot of opportunity to interact in person, and the students are getting an opportunity to interact and to bond with each other. So operationally, when people asked us this question last year, we had to answer, I don't know. But our hope at that time was that it would look something like it does now. We are optimistic that if the world continues improving the way it does, we'll even be able to get rid of the masks by the time our next class arrives on campus next fall. Now, in terms of content, from a content perspective, we are most certainly embedding lessons that have been learned from policy lessons that have been learned from COVID-19 into the lessons across our courses. So I view the policy response made by central banks, finance ministries around the world to COVID-19 as being enormously successful. If you look, for example, in the United States, poverty rates fell last year. Also, we did not have a financial crisis. We should not make that a reason to not study the things that central banks did to prevent such a financial crisis from happening when it looked like we might have one. And so we are using those as examples in the classroom. So I expect that there's a lot that we have learned from the policy response to COVID-19. We will continue to learn that. We'll continue to use that in our teaching and in our courses. June, why don't I turn it to you for some more of the questions that we've received in advance, and then before we go to some of the questions we got in the Q&A, let's cycle back over to Bill.
Sounds good. All right, so the first question I got is the GMAT results. Is the GMAT result preponderant to the admission to the MMS and systemic risk? So yes, we do require people to submit GMAT or GRE scores. So it doesn't have to be just GMAT scores. If you would like, you can take the GRE. The way, and as Andrew alluded to before, the way we utilize these scores is really to kind of assess and ensure that the people who are coming to our program are prepared to take these classes that we offer that require the level of math that is required for an MBA class. And I understand a lot of you guys probably have been working for a really long time, so jumping back into an academic setting might be slightly jarring. So we just want to ensure that everyone is prepared and everyone has this kind of the minimal required background to be really successful in these classes. And that is one of our main goal, is that we bring in a small class, but we really want everyone to thrive and not suffer in taking our classes and being in the community. So that's really the only way that we utilize the GMAT score or the GRE score. So that is why we don't have a minimum cutoff, because we not only utilize that, but we also look at your GPA to also assess whether the person is prepared or not. So that is why we do require the score, and it is really helpful for us to understand the preparedness of a student. The next question is, after submitting my application, how much should I wait to get a final admissions result? So we try to push through our admissions process pretty quickly, because we do not want anyone, sitting around kind of waiting for a month or two to really hear back from us. So, and we understand you're also working with your internal processes within your home institution, and there needs to be some, quick response from us for you to also start your internal processes to get approved for your leave and get approved for your financial support. So really, when we see 1 or 2 applications that are sitting in the pool, we meet as an admissions committee and try to make a decision pretty quickly within a week or 2 when we see an application come in. But also, when you submit an application and when you're working with a deadline, really just feel free to reach out to Ashley and myself, so that we know that you have a deadline that you're working with in your internal home institution, internal processes, so that we can also help you out in kind of moving forward the admissions process and helping you out with the internal process that you have that you need to meet deadlines for. So, feel free. And the one good thing about working with a small group is that, we are very hands-on and we are very responsive to any questions and requests. So please let us know, if you have any restraints or restrictions on your end. And then the last question I have on my list is, could I take more than 2 electives? So once you're admitted to the systemic risk program, you will have a list of core classes that you will be required to take. You also have electives that you need to take that are, and the electives have certain requirements. It either has to be econ, finance, or statistics. And you really don't have that much space within that, the required, credits to graduate, to really explore outside. But also what Yale is really great for is that, they don't have a ceiling for how many classes you can actually take. So it really depends on your personal ability. And if you're comfortable, you're not restricted to the ceiling of 36 credits that we have. That is a minimum requirement of graduation for the systemic risk program. So, we have many, many students that have taken more than 2 electives per semester, because they felt like, they had the ability to, and they were very comfortable, finishing all the assignments. The other thing is that you're also allowed to audit classes. So that means that pressure to, have the assignments completed every single time is a little bit lessened if you are auditing a class. So that way you can also have the exposure to the class without the pressure of having the completing the assignments. So, and then also another great aspect of Yale is that you come to us and all the Yale courses across the university are open to you. So you are free to take any of the classes that really interest you. So for example, if you're really interested in kind of the climate changes and the interaction between climate change and central bank and how they're assessing financial stability, and you really want to learn more about how climate change might be affecting the economy, there are plenty of classes you can take, in the forestry school where they are very focused on these issues. So there are a lot of options, and we can really help between all the faculty at systemic risk. We can help tailor your electives depending on your interest and kind of your career path that you're foreseeing. So you will have a lot of options. That is, I guess, my answer. And yes, you can take more than 2 electives. So I think that's all I have on my list, Andrew. So you can turn it over to Bill.
Sure. Let's move. You know, we're financial stability nerds here, the three of us, and we like to have others who come and join us who are really interested in financial stability topics. We have lots of good conversations, and the nice thing, perhaps nice is the wrong word, but the thing that makes this field an interesting one is things change a lot. We get new topics, new things to worry about all the time. And a recent very hot topic is central bank digital currencies. So in some sense, central banks are being pushed to really think about this maybe earlier than they would have liked to. They've enjoyed a nice monopoly on money creation for a long time, but the private sector is encroaching. And it's now, I think we're up to something like 80 central banks that are considering experiments in central bank digital currencies. One question we often get is, what are the impacts of this for financial stability? So if you care about having crises and fighting crises, how should we think about the impact of central bank digital currencies? So for that question, we turn it over to our resident central banker, Professor Bill English. Bill, I imagine you're getting this question on an almost daily basis now.
I am indeed. As you say, Andrew, central banks, it seems there's outside pressure, but I think also pressure among central banks to kind of be in the club, as it were, and participate in this work and work on this topic. So there are a lot of central banks who are thinking about this, and so it clearly raises a lot of questions about all sorts of regulatory issues, but financial stability issues for sure. So just to be clear, central bank digital currencies are essentially just a digital form of cash. Instead of having pieces of paper in your wallet, you have electronic pieces of paper in your digital wallet, and you use those to make purchases. But what makes them different from having money in an account at a commercial bank that you can use to make digital payments is that they are issued directly by the central bank. So this is central bank money, not commercial bank money. And there are many possible advantages of such a product. Just to touch on a few that have been emphasized. Some people think that it could encourage the efficiency and innovation in the financial sector. We have kind of sclerotic old firms that have established positions in markets, and they're not doing a very good job, arguably. This is a way of prodding them to do a better job, to become more efficient. It may allow for better access, greater financial inclusion. There are people who don't have bank accounts. And if you had central bank digital currency, maybe there are accounts at a central bank. There are different ways of setting up a central bank digital currency. In some sense, the central bank can set it up in a way that's very easy to use and give people access to financial services they might not otherwise have. And also it could be very useful for monetary and fiscal policy. The interest rate paid on a CBDC is going to clearly be a very key benchmark for monetary policy. And if you want to do fiscal transfers in a downturn, if everybody has access to central bank digital currency, the central bank can just distribute funds to people very quickly and easily. And so these are potentially very, very large benefits. But there are a bunch of risks in addition that raise kind of hard design questions. And some of those key risks are financial stability risks. So one is that if there's literally no paper currency, you just get rid of that, all you've got is CBDC, then you lose what is potentially a very robust payment system that could be used if a cyber attack or some other problem hit digital forms of payment. So you can imagine scenarios where because of just bad luck or a bad actor, it's hard to use digital forms of payment. And in those sorts of circumstances, currency is a very robust system. You don't need a lot of stuff. All you need is wads of paper and you pass them around. So people could buy groceries and buy gas or whatever with currency. A second big issue that this raises is if it's successful, if people really like the central bank digital currency, and again, that'll depend on a bunch of design parameters, it could crowd out bank deposits. So currently people are using bank deposits to make a lot of payments, or debit cards and credit cards, but the credit cards ultimately come back and are paid off with bank deposits. So let's say the Fed introduced the CBDC and people really loved it, and they just wanted to use the CBDC. The Fed became the retail payment system for the United States, and bank deposits largely went away. Well, that would, if nothing else changed, shrink the size of the banking sector a lot. They wouldn't have deposits. They wouldn't be able to make loans. It could create liquidity problems for banks in the near term. And over time, banks just wouldn't be there to be intermediaries in the way that they are now. So I think that's a problem broadly. It could be a particular problem in a crisis. So I think back to the fall of 2008, when there were real questions about some of the major banking institutions in the United States. If there had been a CBDC that had been available, I suspect a lot of people would have said, to hell with Bank of America, I want my money at the Fed. And so CBDC in some sense could encourage runs on banks in times of stress. So the question is, what do you do about that? How do you try to manage that risk? I mean, one way is, of course, just make the CBDC not that good. So it's not a very good competitor. But that acts against the benefits that you think you're going to get from the CBDC, that it is prodding the incumbents to do a better job of providing efficient, low-cost transaction services. There are other options people have discussed. You could have a cap. So Andrew could have only $1,000 of CBDC, and so people can't just run to CBDC. Everybody could have it. You could still get benefits in terms of greater access, but the size of it would be limited. You could also do that kind of less draconianly by say having an interest rate on CBDC that's a market rate for up to some level, $1,000, and after that it's very low, and maybe even it gets negative after the level of CBDC gets really high. So you could try to limit the use of the CBDC, but I think that actually undermines some of the benefits. Another thing you could do is the central bank could say, fine, we take the CBDC, we take the deposits from the banks, but we lend it back. So central banks generally have a lending facility at which banks can borrow funds from the central bank. And so you use that facility a lot to return the deposits, recycle them back to the banking system. And that could work. But then you have to think hard about the rules around such lending. What are the haircuts? What are the rates? Are there limits? Are you worried about moral hazard, that if banks can just get deposits like crazy from the central bank, that then they have less incentive to limit their risk? So there are some headaches around the potential systemic risk implications of having a CBDC. So I'm happy to talk more about that, but maybe I'll stop there for now.
Great, thank you, Bill. There's a lot, definitely a lot to think about on this topic. We have one other technical type financial stability question that was posed to us beforehand, and so let me answer that before we dive into the questions that have been posted in the Q&A. And I encourage Bill and June, take a look at the Q&A if you haven't already, because I may throw some of these your way. So a question that we received, and I will parse it and give some definitions. It is, why are rehypothecation limits not internationally governed? Okay, so let me explain what this question is asking. It's a great question, and why it relates to financial stability. So a lot of financial transactions take the form of effectively a secured loan where, for example, I need to borrow money from June. I borrow $1 million from June, and June asks for collateral, and I give her, say, a government bond, a US Treasury or Japanese government bond, and I give that to her as collateral. And often these types of transactions are structured such that it's not actually a loan, but technically an agreement, a sale and repurchase agreement, which is called a repo. So I'm actually selling the bond to June with the promise that I will repurchase it tomorrow. And that simplifies what June is able to do if I can't pay the loan back, because she already has the title to the bond. Okay, but one thing June is actually allowed to do herself then is she can go over to Bill and borrow $1 million and give Bill that same piece of collateral that I gave her in the same fashion, such that we have loans now going through the economy and collateral flying in the opposite direction. That movement, that second movement of collateral from June to Bill, is called rehypothecation. Okay, so I have hypothecated the collateral to June in the first place, and she has rehypothecated it off to Bill. And so just as we think about the velocity of money, you can also think about the velocity of collateral, which is kind of this sequence of rehypothecation. Now, individual contracts can limit that. When I give the collateral to June, the contract that we have with each other can restrict her. I can restrict her from being able to rehypothecate the collateral and send it out to Bill if I want. Now, of course, if I write that restriction into the contract, that's going to cost me something. June is likely to charge me a higher interest rate. So in general, unless I have some real important reason I need to get exactly that piece of collateral back from June and not something that looks like it, I'm not going to place those restrictions in a private contract. That leaves the public authorities in a bit of a quandary. So the whole world might be passing collateral around willy-nilly left and right. And if there is some kind of collapse somewhere in that chain, it might be an extremely messy thing to fix. But no one individual in that chain was necessarily worried about that. I don't worry when I give collateral to June about the stability of the whole global financial system. I worry about the stability of my own bank account. Okay, so therefore there's a real possible negative externality towards the excessive movement of that collateral, excessive rehypothecation. And the question that was asked is, why don't we have some rules about this? And the first answer to this question is, it's not that we shouldn't have rules, is that we're kind of nowhere near the level of data collection and control because these are private contracts. Not many of the players here are not regulated institutions. So in the example I just gave, it wouldn't be unusual for June and Bill and myself to all be, offshore hedge fund vehicles that are domiciled in some very, very low regulatory environment and maybe never touch a country with a strong regulatory system. So there's complexities, given that these are private contracts. Any rules that we put in place, even if we had the data to put them in place, would be easy to evade. And that raises the general question of how is it that we can regulate and manage systemic risk in a world where finance is global and shadow banking is not an industry, but kind of an idea. Shadow banking is pretty much everything that you are currently not regulating. So, and we're very good at rewriting contracts in ways that they evade current regulations. So this topic, broadly speaking, which is the growth of shadow banking, the migration of activities outside, and how we can try to control those activities, of which this question of rehypothecation is one type, is a subject we talk a lot about in our program. I don't have an answer to this specific question, but we do have principles, and we do discuss how institutions might go about that. So we have now a set of a long, nice set of interesting questions. Let me take the first three. I usually just rely on June to answer all the questions about scholarships and price tags and things like that, because we of course do get a lot of questions like that. So I'm going to give her a break and answer this one, these first three questions that we got in the Q&A myself, so you can understand the spirit of what we do and why we do it this way. So there's the first three questions. I'm going to take them a little bit out of order. So the third question says, are there opportunities for a scholarship? And then the second question that we received kind of really explains why we should have some opportunities for scholarship. They say with the fairly high price tag, how have you found people in previous cohorts who work and continue to work in public service? How do they end up funding it? Okay, so let me explain a little bit kind of how, what our philosophy is here. We do want people, generally they're coming from public service, and we do really want people to go back to public service. That's the goal of the program. So how can we charge what we're charging if we're really expecting that? And I think the answer is that the majority of our students, the vast majority of our students, come sponsored by their institutions. And we believe that the value proposition that we are offering to central banks is a very good one, that it is in the interest of a central bank to pay these large fees to Yale to send their talented young people here, because we believe it's going to save their country and expectation more money than that when they go home. And that works for some central banks have those programs, and that works, and some central banks don't, and it's harder. We do occasionally have individuals who come and pay for it themselves, and we're not designed for that. I don't really want people coming and using their own money, because I want them to go back to relatively low-paying jobs compared to how talented they are and what they could do in the private sector. And we don't offer any kind of placement, anything like that. So we're really, we think that the majority of our students kind of forever are likely to come from institutions that can sponsor them. There are some international sources of sponsorship that go through various places. If you're creative, you can find them. The World Bank has some. That some of those programs go through home institutions as well. So it goes through the international institution and then to your home institution. But we really don't want to take your money. We want to take your institution's money. And partly, we're doing this program at Yale where every time we bring in a student, we kind of take a seat away from a paying customer in one of Yale's general, for-profit private sector programs. So we can't really, the institution Yale's been very nice to us to let us run this program, which we think is in the public interest. But we can't make Yale pay for it. So we're hoping that we get the institutions to pay for it. So are there opportunities for scholarship? They're limited. They're limited kind of in general to what the opportunities are for scholarships at our school in general. We don't have any specialized scholarship funds for our program. So we kind of have negotiated with the school so that we can offer some limited scholarships. But those limited scholarships are almost always going to go to people from kind of World Bank lower income countries. And our ideal is not that the person is paying and we're giving a scholarship, but rather that a central bank from some countries or a finance ministry from some of those countries that might not have as extensive a program that we could have some break for that. But it would be a very rare circumstance where we would be able to pull together the funding for more than half. And it would be quite rare when we can do half. So really what we encourage everybody to do is please, work hard with your organizations. They often have these programs. We're happy to fill out any of the forms that need to be filled out, but we don't want people to become poor coming to our program and going back to their central banks. We really believe that we're helping the countries to become rich, or to at least prevent becoming more poor in a financial crisis that can hit any of us. And so that's our suggestion there. The first question on the list, which is related to these, is can we apply to the program if we're not connected with an institution? And the answer is yes, but in those cases, you might be able to find some outside funding. There are scholarships, of course, available to people. Scholarships from that are open to people not from an institution that are not Yale based that you could get, and I would hope that people who come would be getting those. We do usually have about one student a year who comes in who is not from an institution and who's not sponsored. And in our case, we try to be really sure that this person that we're not sending somebody back out into poverty, because we are not the optimal way to come and find a job in the private sector, right? There's a lot of programs at Yale and elsewhere where you would pay what you're paying for our program and be able to find a private sector job. So if you're going to go back to a public sector job, a lot of times the folks who come in from outside an institution, they either have some money or they found some scholarship. They found some scholarships from outside of standard sources. Okay, with that, we got a bunch of other questions on the list, and I thought, June, there's a set of questions here towards the bottom that are closely related to the program. I thought I'd throw those to you, and then Bill, we do have a question about CBDCs. Which I think you could see in the Q&A, which I'll throw back to you after June answers hers.
Sounds good. All right. So I think you're talking about the last three, right, Andrew?
Yes.
The first one asks about, is there any class that presents the modeling of systemic risk through the most advanced macroeconomic models or econometric models? So our macroprudential policy class, which is our required class, is perfect for this, where that is what they do for a full year. You discuss models, you discuss designs on how to measure certain financial stability related metrics. So that would be the class that would be dealing with this specifically, especially if you're looking for modeling of systemic risk. Modeling of general different models that if you want to learn that is at a higher level, those are, you can find those at Yale SOM or with a different department at Yale, be it a PhD level class or a master's degree level class. There are varying degrees of those, and Andrew, Bill, and I can help you kind of navigate through and find what fits best your level of expertise in this and what you're looking for. And then what are the typical number of years of experience? It really varies depending on which country they're hailing from. I think this year we have people who have had 2 years of experience, 3 years of experience, to generally India, we usually hail people who have had 15 to 20 years of experience. So it really depends on your central bank or regulatory agencies, what their policy on the leave is and what their policy of internal scholarship process is. But what we find is that, regardless of the typical years of experience, they're all kind of coming from similar background and similar interest in this financial stability world. So even though you have 2 years of experience, I wouldn't be worried about not having enough background knowledge as opposed to somebody who has a 20-year experience, because I think everyone kind of comes with the same amount of passion about these subjects. And it's really not the years of experience that differentiates a student and affects the student very much in taking our classes, but it's really the passion and the interest and the future career path of what you want to do in your institution. So there is no limit, and there is a wide variety, and we find that it's always interesting to have a wide variety of students. And then I think the last question is, when is the application deadline? So our tentative deadline is January 1st. And we highly and strongly urge everyone to apply by January 1st. And if there are materials that you cannot submit by January 1st, please reach out to me and Ashley and let us know that you have started the application and you have filled out everything you could except for certain outstanding items that you have. For example, exams, if you can't schedule before January 1st, but you have scheduled for a different date afterwards, just let us know so that we know and we can mark it off in our system that when the score is coming in, so we can keep an eye out for those. Also, if you have a nomination process that is taking longer, also let us know so that we can keep a note of that. Generally, January 1st is the suggested deadline. And we're more than happy to work with you on adjusting these deadlines as long as majority of the materials of the application is submitted by January 1st. So, if you need individual tailoring, just reach out to us and we can help you out there.
Thank you, June. Bill, we have a follow-up question on CBDCs.
Yep. So the question is, if CBDCs become successful, is it right that commercial banks could lose all of their retail business? I think the answer is yeah, absolutely. I mean, that is a risk people are focused on. As I said earlier, if the CBDC is just a better retail payment system, then a whole lot of bank deposits will move to the CBDC, and that creates a real quandary for policymakers, because on the one hand, maybe you have a better, more efficient payment system, but on the other hand, you've just disintermediated your banks. So you have to figure out basically how to re-intermediate your banks. And that either means you've got to put some limits on the CBDC, as I described earlier. Maybe, for example, you offer lower rates or even negative rates on large CBDC balances to try to push them out, or you lend the money back. So the central bank takes in a huge amount of deposits, essentially, from the commercial banking sector. There have to be assets on the asset side of the central bank's balance sheet to balance those liabilities, those deposits. So the central bank is going to have to accumulate some asset. Well, it could go out and it could buy treasuries or whatever, or alternatively, it could just say, fine, we're going to lend back to the banks. We're going to use a lending program and set a bunch of parameters for that lending program. What's the rate at which you lend, and what's the collateral you require, and what are the haircuts, and so on. And then given those parameters, you would lend back to the banking system the deposits that flowed out of the banking system into the central bank. As I mentioned earlier, I think that raises some hard questions about exactly how do you want to set up that lending program. You'd worry that could have moral hazard consequences. You'd worry that it's just the central bank meddling in the allocation of credit in a way that central banks usually don't want to meddle. And so I think it raises a bunch of hard questions. But if you go back to the pre-financial crisis period, the way the ECB implemented monetary policy was with loans to depository institutions. They didn't want to buy sovereign debt. They thought that was a problem. And so instead, they did a lot of lending to commercial banks in the euro area. So it could be done, but you'd want to design it very carefully and think about the consequences of what you're doing.
Thank you, Bill. I have another question. I'll take this one. A question from Nathan, who says, Governor Baumann gave a speech regarding the lack of community bank creation in the last decade. What role do you think community banks have in financial stability, and why do you feel they don't get the spotlight that's currently occupied by CBDCs and climate risk? So first, quick definitions here. So in the United States, community banks generally mean small banks. So they tend to have different charter types, but they're not the money center banks. They tend to be they represent the class of smaller banks, and we have a lot of them in the United States. Every country has a form of community banks. They're just called different things in different places. They're the ones that cater to a local audience or a regional audience rather than something the whole country, and they're not in money centers. They do a lot more lending to small business in their area and for people to buy houses and less of the big Wall Street types of deals. So the question is, we don't have all that much community bank creation in the United States, and is that a problem? And one thing I would say is that in the United States, we've basically been having consolidation of the banking sector for, as long as I've been alive. And partly that is because historically, we had a lot of restrictions on banks' abilities to branch, to banks' abilities to grow outside of one unit. So it was hard for them to have branches in some places, more than one branch. And it was often and it was impossible until fairly recently for banks to incorporate across state lines. So you had big banks that were national, but they were like 30 different banks with 30 different incorporations across state lines. So we had a system in the United States that encouraged banks to be small. And since at least the 1920s, we've been shrinking the number of banks that we have in the United States by a fair amount. So that now we probably have 20% of the banks that we had in the 1920s, and probably 1/3 of the banks that we had in 1990. I mean, we are really consolidating. So to some extent, you wouldn't really expect there to be community bank creation because we've changed the rules so much over time to take away a lot of the natural advantages, the local monopolies that we were granting to community banks, that in some sense, we probably still have too many small banks in the United States from the perspective of social welfare. Now, what's their role in financial stability? In most countries, and in the United States is one of them, we don't tend to think of small banks as being a main financial stability risk. That might be a mistake. In the Great Depression, it was really quite small banks that were the ones that had trouble and not the too big to fail institutions. So there's going to be cases where the contagion will happen among smaller banks. But these days, in the more complex financial system that we have, much more of the worry tends to be about large externalities of failure from large institutions. I would say that. I would say, I would add to that, however, it's not the case that community banks, that small banks here and everywhere, it's not the case that they are politically not powerful. They are very powerful politically. I was surprised. The brief time I worked in Washington, I kind of believed that it would be the large New York banks that had all the political power. But it turned out not to be true. The large New York banks have the political power of New York, whereas there are very wealthy community bankers in every town in the United States, and they all vote and give money to their local politicians. And so when we were doing financial reform in the United States, the community banks got pretty much everything they wanted because they were really quite politically powerful. So I think that'd be my answer on the community bank question. They're important. Perhaps they should get more attention than they do, but they certainly are. They're certainly still a very profitable niche of the banking sector. Okay, so we have another question here, and maybe June, you could take the first crack at this. I'm happy to take the second, and if there's no more questions after that, then I would be actually interested in Bill's answer, since he has the most experience among us in supervising junior people who worry about their careers at central banks. So the question is, what would be the benefits of this course to someone who is already managing teams and not in a junior position? So I have thoughts. I imagine you do as well, June. So go ahead.
Sure. So I mean, basically we are, I think Andrew alluded to it earlier, that our program is really to train, current policymakers who to prepare and to understand, if there is a financial crisis, what are you going to do? And really, that is not something that central banks think about or regulatory agencies think about all the time, because financial crises don't really happen that often. So, what we aim to do is really that to equip everyone with a basic knowledge of everything, a little bit of everything that you need to deal with a financial crisis, right? So that's why we have macroprudential tools class, why we have central bank class, monetary policy class, a class that Andrew teaches on global financial crisis, and a class that I teach on regulation. Is that we're not aiming to breed lawyers or economists, but we are aiming to breed policymakers who have the expertise to understand all different aspects that come into play when you are dealing with a financial crisis and when you are making a decision in a financial crisis. So I think in that aspect, that is what you are thinking, what we are thinking about in really great, breeding, like training people on, is that that we really want a student to go out and 10 years down the road, you're in a leadership position and there is a financial crisis. You understand every bits and pieces of moving parts that needs to fall into play to really have an efficient response to a financial crisis. So that's my response.
Thank you, June. And I agree with everything June said. I would add that we spend a fair amount of time also in our classes talking about what you do in the financial stability function kind of in peacetime, outside of the crisis. June is absolutely correct that there's a whole lot less of studying what to do in a crisis in a central bank. So we tend to do a lot more of that than you would see in your job. But we know that in most people's jobs, you spend a whole lot of your time on prevention, and a lot of the attention in our courses is to that. And to emphasize what June said, really, there's two reasons you come to the program. I would say two main reasons. One is that the credential and the signal that you have learned in this area is valuable for an internal process of getting promoted, and that's going to be of more value to junior folks. But the second reason, and the one that I think is more important, is what you will learn. So if you are already running a financial stability group in your central bank, you might know most of the stuff that we're teaching in the program, in which case it wouldn't be of that much interest to you. But it might be that you ended up in this job really because there was nobody more qualified than you. And when you sit there and look out the window, you think, I'm not qualified. I don't really know everything I want to know to have such an important position, and I'd like to take some time to learn some more. So it is the learning that at any level, wherever you are in your organization, you might realize this is much more important now for maybe because of the position I have or because of the challenges we're facing, for me to know more about this. And coming to the systemic risk program at Yale SOM, that's our main goal. We will teach that to you. We will teach you, as June says, kind of at least a little bit of everything you need to know, and then some of the stuff that you think you really need to know. I don't know, Bill, what your experience is, having managed, hundreds and thousands of people over the years.
So I think a key part of the answer to the question, which both you and June got at, is benefit for whom? Who are we talking about? And I think there are different possible beneficiaries. So one is you. So you're a manager at a central bank. You have a team of people who work for you. How does this make you better off? And exactly as Andrew and June have said, we are trying to teach a set of skills, a body of knowledge that will make you more effective at your central bank. So you will be a better decision maker. You'll be more forward thinking about possible financial stability risks. You'll come home with some tools that can be applied at your central bank to try to, for example, identify building risks or something like that. So you would be better off, you'll get promoted and so on. Another benefit, I think, is that you will be interacting with central bankers from other central banks here. And we try to support interactions after graduation, after you're back at your central bank, between the central bankers who were here. And so in addition to what you learn in New Haven during your year with us, you'll also potentially be learning from your colleagues. When you're back at your central bank and something comes up, you'll have people that you can reach out to and talk to and learn from. So I think there are potentially large benefits for you personally. Who else? I think there are big benefits potentially for your team. You're a manager, you have a bunch of people working for you. when you come back from New Haven and you've learned some material about various issues, you can then teach your team. You can point them at the right things to read, tell them about some of the skills that you learned, and basically be a more effective leader. I think a lot of leadership in an institution is very much about the institutional stuff, but at least if you're like me, the people who are under you will also be looking for, how do I learn some new things? How do I expand my horizons? How do I end up in your chair, English? And so this will give you a bit more to talk to them about and to teach them about, and advice to give them about how they can become more valuable, productive central bankers. And of course, the last thing that Andrew talked about is, I do think you become a more valuable person for your central bank, and our hope is that over time, as a result of coming to Yale, you move up at your institution. Your institution loves you and finds you valuable, and you make your institution a more effective institution in dealing with these questions. And so I think there are benefits for you, but also for those around you and for your institution from coming here. Clearly, if you already know everything we're going to teach you, then it's not going to be that helpful. But for a lot of people, that's not the case. And you can come and you can learn a lot and take that information and your experience here and your interactions here at home.
Thanks very much, Bill. We have one. This is a great question, and let's take it. Even though we just have, even though we're out of time, let me answer this question. Is it possible to do a dual degree, such as with an MBA? And the answer is yes. We don't have one this year, but we've had about one a year for most of the years that we've done this. Typically, it's a student who has started in the MBA program here, who does the first year in the MBA program here, and during that first year learns about our program. And what's nice about the way the Yale MBA works is they basically can just come do our program in their second year, and they have, with no extra time, graduate with 2 degrees, a Yale MBA and the Master's of Systemic Risk. And that's because of the flexibility of the Yale MBA program, where there's no required classes in the second year. Everybody does all electives, so you just choose to do all the electives in our program. The other direction, we've had students do that, but that's a little harder because Yale's rules, if you're going to do the MBA here as a dual degree, is that you need to do a full year of classes at Yale after you do the Yale core classes. So after you do the SOM MBA core, you need a year. So we're perfectly situated to be that year, to be the second year of an MBA program. But if you do our program first, Yale doesn't recognize that. They'll give you our degree, but you would still have to do 2 more years for an MBA. The idea being you learn a lot of things in the core of our MBA program, and then you apply those things in some set of other classes in your second year. So you need to do ours second to make that work. And so you need to get in to the Yale MBA program kind of at the same time. We did have a student who really wanted to attend an MBA program at the University of Chicago, and he was already admitted. And he decided that he couldn't decide between the 2 programs, so he just came and did us first, and then he went off and did the MBA at University of Chicago. So that took him 3 years. So that's not a dual degree, but that's a combination. Something that was not asked, but I should mention, we also tend to have 1 or 2 students a year quite interested in doing a PhD afterwards. And we've gotten better at helping those students. You know, we didn't realize how many of them there would be, and we've gotten better at helping them and helping them to get the coursework, et cetera, to be able to move on. And in fact, one of our students this year is enrolled in one of the top finance programs in the United States at the Kellogg School of Management at Northwestern. So we think that a lot of times people will be even more valuable to their institutions if they get multiple degrees, and we're happy to help facilitate that. Okay, so seeing no more questions and reaching a couple minutes past the time we said we would keep people, let me thank you for attending. and for your great questions, and thank my fellow panelists for their wonderful answers. Everybody have a nice remainder of your day.